Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we're going to make the best investments that we can. So thank you so much for joining us. And on today's show, we have Ralph Baker. And on Seeking Alpha, Ralph is known as Shock Exchange, and that's a name that he gets from his youth mentorship program that teaches both investment management skills and competitive basketball skills. Pretty cool, huh? And Ralph actually started learning to invest back when in the fifth grade, when one morning his dad gave him a copy of the Wall Street Journal and told him that he's going to quiz him on it at the end of the day, and he did, and he kept doing that. And since then, he's spent decades in the M&A space. And when it actually came time for him to teach his kids about investing, he decided to also include the community, and his youth program was born. And if Ralph can teach kids to invest, and those kids, by the way, went on to predict the Great Recession, I'm convinced he can teach us as well. There's lots of highlights in the show, and I'm excited to share it with you. Thanks so much for joining us today. And remember, our goal here is to help you learn to invest. That's financially and in all of life. And you can always find more at investorinthefamily.com. Also, I'm launching this week something new, and I'm starting a reading group on the book, The Intelligent Investor. If you've been investing for any period of time, you know exactly the book I'm talking about. It's by Benjamin Graham, and Warren Buffett said it is by far the best book on investing ever written. Okay, so if you are a serious investor, if you're someone who wants to lay foundations for a lifetime of successful investing, you want to read this book, and you want to be able to digest it, and you want to be able to apply it to your life and to your investing. So I'm starting a reading group, and I'm limiting it right now, this first round, to 15 people. And it's free. There's no monetary cost at all. But this is for people who really are wanting to grow as investors. It's for people who are willing to set aside all of the noise of investing for a month or so and focus on actually becoming better investors and reading this book, getting together for some conference calls or webinars to discuss it, being involved in an online forum where we're going to discuss the book on even more depth and actual applications from the book as well. I'm very excited about this. This is a new offering for us, and it is by application only. Again, no monetary cost at this point, but by application only. And the application, you can find it on the show notes for this podcast, as well as on investorinthefamily.com. And if you're a subscriber, you will have already received an email with a link to the application. And I'm going to close the application after about a week, limiting it to 15 spots. Be sure and fill that out if you're interested at all. And I'm really excited to be able to share that time with you together as we both look to grow as investors together. So thank you so much in advance for your interest, and hope you enjoyed today's show with Ralph Baker. Well, hey, Ralph, welcome to the show.
Thank you. I'm excited about joining.
Well, we're honored to have you here and appreciate you giving us some of your time this afternoon. And I'd love to get started, if you don't mind, just giving our audience a little bit of background on you as an investor and what you're doing now in the investing space.
Well, my background's in mergers and acquisitions. Okay. I cut my teeth doing insurance deals for GE Capital and LBO lending for GE Capital in the mid-'90s after business school. And I also did some insurance M&A for a large insurance company, and then also some transaction services for one of the accounting firms. So I have a hodgepodge of investing experience. I guess most people know me as having worked with this financial literacy program in Brooklyn, New York. It's called the New York Shock Exchange. I started a travel basketball team for my son back in around 2006. And we teach them how to pick stocks. And so I've been blogging about what they've been doing for a while. And also I wrote a book about their experience, how they predicted the Great Recession and the pain ahead. So right now I'm basically doing some entrepreneurial stuff, and I also try to pick stocks where I do this a lot of research up front and then try to find mispriced stocks. And I write about it on for Talk Markets. I also write about it for Seeking Alpha, and try to get feedback from investors and from the audience to determine if it's a good idea, a good investment, or a bad investment. And so it seems like it's been working well. I've been getting a lot of feedback so far. So that's basically what I'm up to now.
Yeah. Well, I would love to start by hearing more about this youth mentorship program. Could you tell me how that got started, and then we'll talk a little bit more about what you're actually doing there?
Well, my backstory is that when I was in the fifth grade, my dad taught me how to read the Wall Street Journal.
Wow.
And he was a former military veteran. He just threw the Wall Street Journal at me and told me to read it. And when he got home, he drilled me on it. And when I had my son, I decided that I would do something similar for him, but try to make it more educational. Not more educational. Try to make it more not necessarily like a military way, but more the carrot and the stick.
Right.
And so basketball is the carrot and the investment literacy portion is the stick. I also played basketball in college. I was a small college All-American at a school called Hampden Sydney College in Virginia.
Oh, wow. Congrats.
All right, so I wanted to pass along, I guess, my passion for investing in basketball with my son. So I named the team the New York Stock Exchange, and as part of the program, the kids had to participate in the financial literacy portion. And I thought it would be interesting, some of the stuff that they would say or some of the stuff that would come out of it. And I just documented everything we talked about. So we basically started with like a couple stocks or a couple companies that they were aware of. And I told them about Peter Lynch, the famous investor from the Fidelity days, that he basically said that you should invest in what you know. And I told the kids and the parents, because the parents were very curious too, as to how would this work and why do you care about financial literacy? This is like 2005, 2006, before the financial crisis, and nobody really cared. And I told them if Peter Lynch can do it, so could the kids, and that investing is really a life skill. Sort of like if you went to an auto mechanic and you didn't know anything about cars, you probably get taken. If you were trying to remodel a house or build a house and you didn't know anything about houses and you just went to a contractor, you probably get taken. Just the same thing with investments. That, these kids' biggest asset other than their home would probably be their 401k plan. So they have to know about investments because they have to pick their own stocks for their investment or pick their own investments for their 401k plan. So it's really a life skill. How you live in retirement, how well you live in retirement could be predicated on how well you pick stocks or how well you pick funds within your 401k plan, which is pretty daunting.
Absolutely. So you would ask them, start with companies that they know of. What would your next step be? How would you move forward?
We basically whittle the list down by telling them about price to earnings ratio and earnings growth rate. So they threw out a list of names, and we would say, well, that's a great list, and we would, of those 6 or 7 names, we would narrow it down to 2 based on these sort of fundamentals: price to earnings ratio and earnings growth rate. And how I explain it to the kids from a basketball perspective would be similar to looking at a basketball player. There could be guys who could be great players, but some of them could have overpriced contracts or underpriced contracts based on their points scored or rebounds per their salary per point scored or salary per rebound. That's how we sort of explain it to the kids.
Nice. And so after you've narrowed it down, how would you guys filter through at that point? We
would just track it with, just go over just tell them about different ways to track these investments, like, about the financial statements. But the main thing we used were analyst reports, something that was real simple. And we also do due diligence. So, for instance, they picked like Apple and GameStop a while ago. And this was for, they were telling me about, this was when the iPod was getting pretty popular. Back in 2006, and so we would go and do due diligence. We go visit the Apple store. They talk to the salespeople, for instance. Look at the new products that were coming out. They would talk to the people at GameStop. They also liked GameStop back then, and we would take them to a GameStop store. And they would look at the new products coming out. They would talk to the salespeople, and you'd be surprised what kids know. They were telling me that GameStop, the personnel back then was more knowledgeable than like going to Target or Walmart, because they actually used the games. They were telling me the iPod wasn't just a instrument, it wasn't just a device, it was a status symbol. Mm-hmm. So people, it was like you had extra status or extra cachet amongst your friends if you had an Apple product. They were telling me this, and and actually their investments actually beat mine. I thought people would think I was picking on the kids, because I had this background in M&A and finance and so on and so forth. And the lesson I got out of it was that kids should make better investors because they're better at spotting trends than adults. They're always trying new things that you and I wouldn't necessarily try new things, but they're always trying new things. So while we're on to maybe Twitter and Facebook or whatever, they're probably on to Snapchat or Instagram or some other tool. So if you can find out what kids are using or what's popular amongst them, and get on the ground early, you could probably make some money because they're almost like their own little focus group. And I ended up writing a book about their findings.
Yeah, and there's a number of reasons why I'm intrigued by this. First of all, I have so much respect for you and for your dad, and that how neat at such a young age that he wanted to instill that kind of an education in you, and obviously it's had a big impact on your direction as far as with your education and your career, and then your willingness to be able to turn around and pass that on not only to your kids, but a broader group of kids as well through this program. And I just have a lot of respect for you for doing that, and I thank you for doing that. And along with that, as I'm hearing you talking, I'm thinking, I bet the things that you're teaching those kids and the lessons they were learning and then even teaching back to you are they're just as applicable to all of us now on Seeking Alpha or whatever website we may be going to for research or work we may be doing. So again, I'm eager to hear any of the findings you have from that, because I'm pretty sure they'll be just as applicable to us as they are to those kids.
Well, one of the major findings, we talked to the kids about, how to value and how to look at stocks. We looked at it from a bottoms-up perspective, price to earnings ratio and earnings growth rate, which is pretty simple. There's other metrics you look at too, but also from a top-down perspective, that there are certain things that can happen where your stock pick could be a great stock pick, but there are certain things that can happen to the economy or the overall market that would make all stocks bad. So we told them about, different macroeconomic trends, about how to look at how the economy is doing. For instance, housing starts and auto sales are probably two metrics you could look at to determine the direction of the economy. And just kept it real high level. And if you talk about housing starts and auto sales, you probably captured about 10 to 15% of GDP. Mm-hmm. And there's other things that go into it as well. But and so over time, we just started tracking. I didn't really look to get anything out of it. And over time, we were tracking it, and we were like, whoa, these trends look pretty bad. And nobody was talking about it.
And this was back in 05, 06.
06, yeah, 05, 06, and 07, leading up to the crisis. And I'm like, so I just started blogging about it. Because we had a website, but I was just blogging about the games the kids were doing, how they performed in games, and how the stocks were doing, but never really blogged about the economy. So I started blogging about it, and that's probably how most blogs get started, because they have something to say, but nobody else is talking about it. And back then, nobody cared about the economics. Now everybody talks about it, but back then, Wall Street particularly was just into quant jocks who could come up with these formulas, but nobody really cared about the economy. So I started blogging about how bad it was, and I said we're headed for another recession. You can see it in the cards. And then when Lehman failed in, I guess around September of 08 it was, all of a sudden everybody's talking about the economy and everybody's kind of scared. And then as part of the book is called Shock Exchange, how inner city kids from Brooklyn predicted the Great Recession and the pain ahead. I talk about the next recession that's coming, because a lot of the policies the government's put in place in bailing out Wall Street and bailing out big business, there's no QE for the people who are actually going to spend the cash. When the economy turns down again, which I think it will, the people that get the bailout money too will hoard the cash, because you have something in economics called lower marginal propensity to consume. So rich people have, for instance, wealthy people, for every dollar in aid they get, let's say they get a $100 tax break, they may spend $20 of it. Right. Where you give it to a lower income or middle income individual, every dollar in aid they get, they will spend maybe $85 of it.
Right.
So that's why I predicted the economy is going to get worse. And that's important, because that drives most of what I write about on Seeking Alpha, that the economy is bad, particularly for these cyclical industries, whether you're talking about oil and gas, railroad stocks. It's in the cards. It's going to happen. Their top line is going to decline. And companies with a lot of debt are going to have a hard time repaying the debt. So that's my overall thesis, that the economy is worse than what people think it is. It's definitely. And
you're talking about right now. This wasn't a prediction 5 years. Yeah, right. Okay.
Right now, there's going to be another recession. It's in the cards. It almost can't be undone now, because there's no QE for the people. Just because you bailed out Wall Street has nothing to do with the economy, because the stock market doing well has nothing to do with the economy. People think it does, but it doesn't.
Right.
The two can be congruent, but in this example, you have the Federal Reserve and the Obama administration are purposely pumping up asset prices and masking the true economic output of the economy. It's almost like when I had an argument with a guy at work a few years ago when A-Rod was hitting 50 home runs a year. I'm telling him he's going to end up hitting 30 home runs. And I would predict he's going to hit 30, and he said, when? And he would say, "Oh, he hit 50. You don't know what you're talking about." I said, "Take him off the juice." When you tell me he's gonna stop taking steroids, I'll tell you when he's gonna hit 30 home runs. At 35 years old, 36 years old, his true home run output is probably in the 25 to 30 range, not 50. So you tell me when the Obama administration, Obama's are benefiting from these low rates, when the Obama administration and Janet Yellen are going to normalize interest rates, I'll tell you when the economy's going to cave. Right now they're masking it.
And so with that, so basically the thesis there, QE is out there and is pumping up markets, but QE is not getting to the people. And even if it was, higher income people, they're saving and maybe reinvesting that money, but the people on a moderate to lower income scale are just spending that money, so they're not able to accumulate or invest it either. But more so, the fact that money, that QE is not getting through to those people at all, means it's not really actually benefiting the overall economy. Is that the thesis, basically?
Exactly. A classic example of this is like the 1964 Kennedy tax cut. He wanted to spur the economy. He had a choice: either give a tax break to wealthy individuals or give a tax break to lower individuals. And the economic argument is that if you had to pick one, you would give it to middle income to low income individuals because they're going to spend it immediately. There may be a single mother somewhere who has pent up demand for maybe she wants to buy a new toaster oven or a new television or more school clothes for the kids, but just kind of waiting till she gets more money, waiting for the next paycheck or waiting till the next whatever. Where a wealthy individual, a hedge fund manager who already has 5 cars, he's going to buy another car if he gets more aid from the government or more stock market gains from the government or from Kuroda or from Draghi or from Janet Yellen. Is he going to buy another car or another house in addition to the 10 he already has?
Right.
When the economy turns down, they're going to hoard the cash. That's based on economic theory and hundreds of years of examining human behavior.
And you mentioned, that when Obama and Yellen choose the normalized rates, that's when the economy will crash or show its true colors, we could say. Of course, the argument there, do you expect them to ever do that? That's one of the other side of it, yeah.
It won't happen before Obama leaves office, that's for sure.
Right.
But there are already signs, though. There are already signs. You look at, usually I would say housing starts and auto sales, but that, you have a lot of investors in housing now. So it's hard to look at housing starts. Because Lehman used to keep an index where they would look at, individuals between 26 and 30. You can set your watch by that they're going to buy a house. When they get 26 to 30 years old, they're going to buy a house. And then when they have a kid, they're going to buy another house, a bigger house. Now you have a lot of investors buying homes to invest. Also have, in auto sales, you have a lot of people borrowing money. Have a lot of subprime creditors borrowing money to buy homes, buy autos. So it's kind of like it's not as apples to apples comparison versus historical data. But if you look at, like, for instance, rail traffic is down about 8% year to date. It's also down about maybe 15-16% year over year comparison. So you see fewer companies sending products by rail because the economy is slowing. That's one good example. You look at rail car orders like Greenbrier companies, Trinity companies. Their rail car orders are down. Trinity's rail car orders are down Greenbrier's rail car orders are down like maybe 65-70% year over year.
Wow.
Because the railroad companies are cutting capex, they're cutting costs because their top line is declining, and that's a good proxy for how well the economy is doing. Rail traffic, for instance, also trucking activity. And
I guess trucking activity is also down.
Yes. Yeah,
the thing I like about, you mentioned back in 2005, you guys were looking at housing starts and auto sales, but like with any kind of indicator, anytime you find an edge in the market, it's an edge as long as no one else is using it. But then obviously once it gets picked up on, you lose the edge of it. And so now, you mentioned housing starts and auto sales, first of all, are a little bit skewed, especially on the housing starts because of investor purchases, which may not have been as big of a factor before, perhaps. But now those things are being followed more. So what else can you look at to find maybe an edge over Wall Street or the greater body of investors out there? So railroad and trucking, I like that. Yeah.
Well, I guess. See, like you're right. Like, you know, the thing about business is that the key to business is that you have to know something that somebody else doesn't. And so now, again, like in 2005, nobody cared about economics. If you told somebody, if you started talking about economics, they look at you like you were a dinosaur. Now, everybody wants to talk about the economy. You can look at housing starts and auto sales in China, India, Nigeria, wherever. Everybody wants to talk about the economy now. So I guess my edge is that, you basically have to actually do the work. Actually, I like, for instance, I may say I think a certain railroad company is a short. I have to do the work though. I actually do write up the income statement and look at the income statement and the balance sheet, write an article about it, and actually do the work and find out, does it have too much debt? Is the balance sheet mark to market? Is there goodwill or inventory or accounts receivable overvalued? So you have to write about 10 companies to find 2 or 3 that's a good investment within that thesis. You follow?
Right. So this actually gets into another question I was going to get to with you, is what your actual investing process looks like. How do you identify potential investments? What does your narrowing or research process look like? And then any filters you may have for actually purchasing. So you've kind of mentioned a little bit, but is there any more as far as identifying? So basically you identify a top level trend and then find companies within that trend and then start digging deep into them. Is that essentially how you get started?
Exactly. So I may feel like the railroad stocks are a good short. So I'm going to be pretty negative, for instance, because I think the economy is slowing. So
right.
That's my overall thesis. And so I may look at railroad. I may look at cyclical industries like railroad stocks. I may look at oil companies. So I looked at oil companies a couple of years ago, but a lot of them had fallen so much that I couldn't make money shorting them. So I looked at derivatives like vendors, like oil field services companies like Halliburton, Baker Hughes, Weatherford International, and then I did write-ups on them. And then because when you do a write-up, seeking alpha forces you to be disciplined. It forces a certain amount of discipline. So I may write a lot of articles about a particular company, and people say, "Why do you keep writing about this company?" Because it forces me to be disciplined instead of putting money into the stock or going long or going short. It forces me to be disciplined and really examine my thesis, and get feedback from the crowd. And so that's basically, I'll look at a couple industries and say, I think this is a good short or a good sell, and then actually do a write-up on like 6 or 7 companies in that space. The 6 or 7 companies, which one's the best company to short? You follow?
I do. I like that a lot. So when you're doing your research, you mentioned income statement, balance sheet. So obviously you're diving into the financials. I assume reading through annual reports, quarterly reports, and I guess that's all part of the equation.
Right. Well, I'm looking at I do it. Lay out the numbers, income statement, and balance sheet. Look at EBITDA. The first thing I look at, I want to know if I do an objective valuation. I think for instance, I may say oil field services company should trade at 7 times EBITDA because they're cyclical. If I find one that's trading at 15 times EBITDA, I'll say, oh, that's a good candidate. Of the 10 I'm looking at, the one with the highest valuation, I may find that as a good short. The one with the most debt, for instance, and they can't pay the debt back, that's definitely a good one. So any company that's balance sheet has too much debt, like Weatherford International is probably one of the most indebted companies in the world right now, next to Petrobras. And it can't repay the debt, so it keeps borrowing more money and borrowing equity, raising equity to sort of delay the inevitable. Let me see what else. A company I wrote about for a while was Molycorp. Rare earth companies. Rare earth prices started to decline in the second half of 2012. They had just made a big acquisition, over $1 billion acquisition, at the height of the market. And when rare earth prices started to decline, they had all this debt on the balance sheet they couldn't service. They also had very low cash, and they had a bunch of inventory that was overvalued because they were building up inventory when rare earth prices was going up. And then when they started to crash, the inventory was overvalued and they couldn't get rid of it. So they had to raise money to fund themselves, just to raise debt and equity just to fund cash flow because the inventory was overvalued. They also had goodwill that needed to be marked to market. So the goodwill was impaired. So I started writing about it.
So that's a great example. So that started with you noticing prices of rare earth minerals were declining. So start with that. So did you, I guess you're reading the Wall Street Journal or reading I guess you just saw an article about that somewhere? Like, how did you even pick up on that?
Well, actually, for the book, I was writing about the demise of China.
Okay.
I thought China would the economy would collapse. And so, in writing about China and how they would, if their economy collapsed, how they would sort of share that pain with the U.S., they would basically start dumping treasury bonds if they had to, U.S. treasuries, if they had to, for instance, and they would also try to increase their, I guess, their trading with the U.S., like lower their prices. You'll lower their yuan, so their prices would be of their goods and services would be lower than ours. So they have a positive trade imbalance with the U.S. And I started reading about it. Then I ran across this example of where some Chinese fisherman was caught in disputed waters, and he was picked up by the Japanese Coast Guard. And China said they wanted him back, and Japan wouldn't give it to him. So what they did was they had an embargo for rare earths. And then rare earth prices went to the roof. And what they realized was that whoa, rare earth goes into a lot of stuff, defense products, toaster ovens, microwaves, cell phones. If we don't have these rare earths, we could be at China's mercy. And so there was a manhunt for rare earth minerals around the world.
Right.
And so a lot of capital came into the space. But the prices of rare earth went to the roof because they had an embargo. You follow? So what happens when they remove the embargo? What happens then?
Yeah, it falls.
Right. So when they removed the embargo and they started flooding the market with rare earth prices, rare earth minerals, all of a sudden, rare earth prices started to decline, and you had these companies who had raised a lot of equity and also funded themselves with a lot of debt. And Molycorp had just acquired a company for like over $1 billion, and again, the first half of 2012. And when rare earth prices plummeted, they couldn't repay the debt. So that's how I came across the rare earth thesis by accident. Cause I was doing a lot of research on China, but the fact that they had an embargo proved my thesis out that China will drop the hammer on the U.S. if they have to. Absolutely.
Well, that's one of the things. One of my thesis, and it's not necessarily part of our conversation, but globally, for so long, there's been such a focus on globalization and more unity between nations and stuff, which has been great. But as the global economy continues to languish and especially not get better and arguably continues to get worse, then you start having this, everyone starts moving back to self-preservation because it's a natural human response to a lack of resources. So if things are getting bad, I want to take care of myself. And that's what I hear you describing with China. And that thing is going to be true with a lot of countries. We're already seeing it, the UK leaving the EU, regardless of whether it's a good decision or a bad decision, they're looking out for themselves. And I think we're going to start seeing a lot more of that. And as long as the global economy continues as it is or gets worse, it'll only accelerate that idea.
Exactly. And I say when that happens, and it will happen, how well positioned are you as a country? And you have countries like Russia and the U.S. that are basically war weary.
Right.
We are a superpower. Russia and China and the U.S. are superpowers, but of the three, China has been able to stay out of wars. The U.S. is war weary. We've spent trillions. China and Russia have spent trillions of dollars on wars, and Russia and China. Russia and the U.S. have spent trillions on wars, and China has not. They've saved a lot of money. The U.S. our debt to GDP is over 100%. China is their debt to GDP is pretty high too, but our debt to GDP is over 100%. What happens when China pulls back and they say we want to sell to you, but we don't want to buy from you?
Right.
We want to keep selling you these cheap. We're going to lower our yuan too. They can always do that. They can always keep lowering the yuan so that their products are cheaper than ours. Are we prepared for that? I think we have too much debt as the U.S. We spent too much money on wars. We spent too much money on bailouts. So we are probably one of the countries that are least prepared to in case this globalization unwinds, which we're unprepared. I think we're one of the countries that least prepared to compete, going forward because of those factors.
So assuming that, how does that affect you as an investor? What kind of things are you looking at or doing in light of that?
I think, like I said in the book, I call it, shock exchange, how inner city kids from Brooklyn predicted the Great Recession and the pain ahead. And part of that pain ahead includes civil unrest. I think the stock market is going to unwind. I think there's going to be civil unrest in the U.S. I think we're seeing it now. Like there was civil unrest around 2011, 2012 around the world, like China, Russia, parts of North Africa, Libya, Egypt, Jordan, and it didn't hit the U.S. But now I just think that bailouts to Wall Street and big business and pension funds, private equity firms and hedge funds is basically what these are. Money directly going to them or indirectly through pumping up the stock market and real estate markets, while swimming in trillions of aid, while the rest of the populace, lives from paycheck to paycheck.
Right.
It's not going to go over well.
Right. I agree.
And I've been saying it for a while, and the government's been saying, "Oh no," President Obama's saying, "I saved the economy," or "Look how the stock market's doing under my regime." 93. Someone did a study and showed 93% of the stock market gains have come from the Federal Reserve. Generated by the Federal Reserve. So Brexit. It does two things. It creates uncertainty for the EU. It creates uncertainty globally, but it also throws cold water. It's almost like you may have pockets of individuals saying what I'm saying, but now you have a whole country saying what I'm saying. That a central bank, European central bank, every time the stock market is about to decline, they put more money into the market. What's that got to do with the rest of the EU?
Right.
What's it got to do with the people who don't have money in the stock market?
Right.
So I think that Brexit is like a whole country just told you that, zero interest rates for 6 or 7 years, pumping up real estate prices and stock and equity prices is complete folly. A whole country just told you that. So what is President Obama and Janet Yellen and Ben Bernanke and The Economist and the Wall Street Journal and they're basically their PR departments? What are they going to do now? What's Kuroda and Draghi going to do now when a whole country just told you what you're doing is pure folly and it has nothing to do with the economy?
Yeah, there's a underwriting mindset that I think is lulling a lot of us to sleep, and it's the idea that, well, it's been 7-8 years or so of the conditions you've been describing, and in the beginning, everyone was up in arms. Oh, this is crazy. This is extreme. This will have terrible ramifications. And then, as typically happens in this case, those ramifications haven't come as of yet. And so eventually people get tired of being wrong. They get tired of predicting things that aren't happening. And you get lulled to sleep and you think, well, this is the way things are. And once that, figuratively speaking, last person falls asleep is when, when things usually end up happening, And so I think my mindset is those of us who are willing to keep our eyes open and realize, hey, those conditions that we said were bad 7-8 years ago, they're still bad. Just because the bad stuff hasn't really shown its face doesn't mean they're not bad. And again, that doesn't mean be extreme with your investments or that kind of stuff or pull out or anything extreme, but it's at least be mindful, at least be aware, look for signs like you're describing. So I know I appreciate what you're saying. So again, you said civil unrest here in the U.S. and a lot of these things. As an investor, does that lead you more toward holding more cash, or does it make you look towards certain types of investments, or how are you doing that?
I still do fundamental analysis, and I'm going to be on the negative side of neutral on stocks, so that the thing about shorting stocks is that you have to get the timing right and the thesis right. So you have to have both to make money. So I'll also I make sure I cover what I'm doing. I may have modest long positions, but maybe net short. I don't go naked on positions because you never know when your company may be bought out, or the company when it's about to go under. Like Weatherford International has raised capital, almost like 3 times in the past. I mean, this year. So every time it's about to go under, it goes and raises equity. Somebody gives them more money. It's almost hard to believe.
Right.
Go out and raise more debt. So it keeps them from going under. So now in this market, if a company's not going bankrupt, investors cheer. Oh, we should buy it. It's not going under.
Sure.
So that's really how I protect myself. You can make money just playing the volatility too.
Right. So you're looking at companies to short. So when you say like a negative perspective, looking at downside potential and potentially investing in that.
Right. Because I think again, I mean, you're looking at the top line. There's no top line growth. It's hard to go long companies when our revenue's not growing.
Sure.
Companies. I mean, you'll see now the stocks are going up because companies are beating their earnings expectations, but they lower their earnings expectations.
Right.
Their earnings aren't necessarily growing. Revenue's not necessarily growing. Just they lower their earnings expectations, and the headline reads, "Oh, they beat their earnings estimate."
Well, and that again pulls back the curtain to so many games that Wall Street plays that a lot of us on the self-directed investor side, just because we don't have the full-time capacity to dedicate to things, and so a lot of times, if we're being honest, we end up cheating on things regarding research, and we don't do enough. We'll cut corners and whatever else. And there may be days and days between when we look at one piece of information and then come back to it as far as a bigger research project. So it's much more easy to be impacted by headlines and what's in the news right now. And I say that because when you look at what you're talking about, earnings expectations being changed and stuff, because so often, at the end of one quarter you'll have, the quarterly report and the call and everything else like that, and they'll project earnings for the next quarter. But if you track that, usually they continue to revise those expectations until they get up to the next report, and so they make sure they always beat and it looks good. And that's where due diligence is so important, and like you said, fundamental investing is so important, because if you're tracking things like that, you can see it and you realize, okay, they're playing a game with us, and because they know that when they report that, hey, or Wall Street knows that when the headline goes out, so and so beat earnings. Generally speaking, that'll be positive for a lot of people. People want to buy the stock because the company's clearly doing well. And, behind the scenes, Wall Street can play that game every time and keep making money, regardless of what's actually going on in that company and regardless of what's actually going on in the greater economy. That's the way I see it. I'm not sure if that's kind of where you're looking to or not.
Yeah, I agree. I mean, people tend to go by the latest headline, and people tend to go by what's in the news now because they've been conditioned to do it. Right. Before the Fed raised interest rates back in, I guess, December, let's take like a year ago, 18 months ago, if something had a positive headline, the stock would just go through the roof. Even if an analyst just said the company's a takeover target, and it could be ridiculous, but the stock would still go through the roof. Right. On that. So the stock was just going up just based on momentum. But as far as, I'm not, the fundamental analysis is probably, if you're investing based on fundamentals, you probably haven't made a lot of money. You just betting with the Fed. That's been more lucrative over the past 6 or 7 years. But if you do fundamental analysis, at least you know why you're investing in a company. It's not based on earnings growth. It's based on because you think it's going to go up simply because it's going up. Right. And it's hard to fight Kuroda and Draghi and Janet Yellen. I think this Brexit thing, it points the whole country just sort of threw cold water on what they were doing. That Draghi and Angela Merkel are not, their policies have not been good for individual countries in the EU. It's been very good for merchant bankers and traders. And as far as low interest rates are concerned, it's almost like this joke Chris Rock used to tell years ago. And he would say, no matter what illness he had, his mother would put Robitussin on it. And so if he had a cold, she'd give him Robitussin. He had a broken leg, put some Robitussin on it. And so the government's been we've been applying Robitussin for 7 years.
That is awesome.
We've been applying Robitussin. Just keep putting Robitussin on it.
That's officially my favorite illustration or joke regarding QE. Thank you for sharing that. That's funny. Well, tell me this, Ralph. This has been a pleasure. I appreciate everything that you've said and the time you spent on the show. As we're wrapping things up, I'm curious, are there any things, any pieces of investing wisdom? You've been investing for a long time. You've been training others in investing for a long time. Are there any other pieces of wisdom you want to share with our audience that you haven't already passed on?
I would just say investing is a life skill, and you just do the work. I mean, do the work on, that's, you don't have to, but you should do the work on every stock you're looking to invest in. You should understand the income statement and the balance sheet and the cash flow statements, and find out, and then look at companies within the sector and find out, of the 6 or 7 companies in the sector, which ones the best, and also look at other markets as well to find out maybe how what's going on in other sectors could affect your investment thesis. So a good example, I've been writing about Micron for a while, and I also wrote about Apple and Samsung. I realized that Samsung was getting hurt in their smartphone market, and they gave up a large part of the semiconductor business to get into the smartphone market. And when Apple started eating that lunch in the smartphone market, I said the only play for Samsung right now, because Apple's beating them in the premium side of the market. They've also come out with these larger phones that have taken away Samsung's advantage. The only play Samsung has is to go back into semiconductors. And when they go into semiconductors and increase supply, that's going to hurt Micron. So because I was looking at Samsung and Apple in smartphones, I knew that Micron was going to decline because Samsung was going to increase supply in semiconductors and memory chips. And then that's exactly what happened. And Micron bulls were saying, well, Einhorn is a Micron bull. So a couple years ago, anytime Einhorn or Ackman bought something, everybody else was buying it too. It was just basically PR for the hedge funds. But and so when the thesis actually played out, people were thanking me, but I was getting harangued for over a year and a half, saying that Micron's best days are behind it.
Right.
So that's another thing that's good for investors to look at. You can see trends happening in different sectors. Don't just look at your sector, look at other sectors as well. But you have to do the work: income statement, balance sheet, cash flow statement. It takes years to become an expert in this stuff. Yeah, no, that's excellent advice. And again, Ralph, thank you so much for your time this afternoon. And I wish you the best and hope you have a great rest of the day. Well, I hope you enjoyed the interview today with Ralph Baker. And remember, you can get full show notes with links and other details at investorinthefamily.com. And if you want to participate in the Intelligent Investor Reading Group, don't forget to fill out an application this week by this coming Friday, which is, I believe, August 12th, for those of you listening to this at different times. Don't forget to fill out that application. Again, there will be a link in the show notes to this podcast. There'll be a link on the show notes at investorinthefamily.com, as well as on the emails you've been receiving from investorinthefamily.com. So thank you so much. Be sure and fill that out soon. I'm excited to have you join us. This is probably the first and only time this will ever be offered for free, so don't miss out on the chance while you get it. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.